Good morning, this is DealBook for Thursday, August 13th, 2026. I'm Andrew Ross Sorkin, and we've got a packed briefing today, from a record-shattering sports franchise sale to a simmering showdown over AI model transparency, a high-profile legal case involving the president's social media feed, and a stunning shakeup at one of America's most storied business magazines. Let's dive in. We start with a note of caution that's been circulating in Silicon Valley but hasn't gotten nearly enough attention in Washington. There's plenty of hand-wringing right now about Chinese open-weight AI models, the kind that make their internal settings, their weights, publicly available, and how they might upend the economics of frontier labs like Anthropic and OpenAI. But here's the counterview that's attracting far less notice. Beijing could clamp down on these models at any moment if regulators decide they're too hard to control. We've seen this movie before. China was remarkably permissive around cryptocurrency right up until it pulled the plug on the entire sector. So while new open-weight models from Moonshot AI, Alibaba, and others are enjoying tremendous momentum right now, the regulatory rug could be yanked out from under them without warning. And if that happens, it would drastically reset the AI narrative in Washington and Silicon Valley all over again. Now to the headline that dominated the business pages yesterday, a proposed purchase of the Los Angeles Lakers by Josh Kushner and Bob Iger that values the franchise at a staggering $12.5 billion. That's a record price for a U.S. sports franchise, full stop. The deal underscores something we've been tracking for a while now, that some very deep-pocketed buyers believe the benefits of owning a world-renowned team outweigh the steep expense, and they're willing to pay up. Here's how it came together, according to our reporting from Michael de la Merced. Kushner and Iger had actually been working for months on buying an NBA expansion team in Las Vegas. But the rising price for that franchise had the two considering an alternative, buying an existing team. On Friday, Kushner called the financier Mark Walter, who had bought control of the Lakers just last year at a $10 billion valuation. Over the weekend, the two sides, notably, without using investment bankers, hashed out an agreement, reaching one by Sunday. But word of the deal leaked yesterday, forcing the sides to acknowledge the transaction publicly. Under the terms, Kushner is putting up personal money, and Iger may as well. Thrive Eternal, an offshoot of Kushner's Thrive Capital investment firm that Iger is involved in, is also expected to participate, though NBA rules would cap its stake at 20%. It's worth noting that Kushner isn't new to sports investing. He holds minority stakes in the Memphis Grizzlies and Miami Heat, and was involved in an eventually scuttled attempt to purchase a piece of FIFA. His brother, of course, is Jared Kushner, President Trump's son-in-law, who runs a private equity firm and was a top White House advisor. For Iger, this is a bold move that will define his legacy. The former Disney CEO, now 66, has a long history of guardianship over iconic franchises. He persuaded Steve Jobs to part with Pixar, brought Marvel and Lucasfilm into the Disney fold, and as he once put it, he understands the power of franchises in a way few executives do. He's also a lifelong basketball fan. This isn't just a financial play, it's personal. But there may be another factor driving the sale from Walter's side. Federal prosecutors have been examining loans made by his insurance business to a Chicago firm over potential disclosure issues, according to Bloomberg. Walter's firm, TWG Global, has reportedly approached investors about selling assets to pay down these loans. The Lakers deal, if it closes, would accelerate that effort, especially considering the team's valuation has jumped 25% in just over a year. This Lakers deal doesn't exist in a vacuum. Investors are betting big on the power of big-name franchises across the board. Consider the recent activity. An affiliate of Apollo Global Management agreed this week to invest $2.6 billion in the New York Yankees. The majority owner of Liverpool FC, the English soccer team, is in talks to sell a stake to an investor group that reportedly includes Jeff Bezos and Facebook co-founder Eduardo Saverin, led by former Queen's Park Rangers co-owner Amit Bhatia. And Thrive Eternal's first deal, announced in May, was an investment in the San Francisco Giants. Thrive Eternal's website hints at the appeal of what it calls iconic franchises. They can withstand technological disruption because their games are can't-miss live events for global fan bases, and they command top dollar for media and merchandise rights. Let's move to our Here's What's Happening section, starting with a major legal development. Luigi Mangione, accused of fatally shooting United Health Group CEO Brian Thompson, is said to be in plea deal talks with federal prosecutors, according to Bloomberg. He's discussing a guilty plea to avoid a federal trial, though he has pleaded not guilty. Importantly, Mangione still faces charges in state court in Manhattan. Prosecutors there will probably oppose any effort by him to dismiss their charges on double jeopardy grounds. In AI news, Anthropic investors are reportedly anticipating a $2 trillion IPO. Unnamed backers told the Financial Times they expect the company to double its valuation from current levels when it goes public, potentially as soon as this fall. In the meantime, Anthropic is in talks to buy Descartes, an AI startup, for about $6 billion, according to Bloomberg. And a plan to sell early access to President Trump's social media posts is being challenged in court. Plaintiffs including The Intercept and the Freedom of the Press Foundation sued Trump and several White House officials on Wednesday, arguing that giving customers access to the president's posts on Truth Social before the public violates the First Amendment. The lawsuit charges that Trump stands to gain financially by giving market-moving government information to those who are willing and able to pay his personal company. Truth Social has so far signed up around 10 customers, who would pay up to $100,000 a month for this early access. The complaint was filed in federal court in New York. Now, inflation. Stocks notched higher yesterday after a tame inflation report was seen to relieve some pressure on the Fed to raise interest rates. The Consumer Price Index rose 0.1% in July from a month earlier, and 3.4% from the previous year on a seasonally adjusted basis. Our colleague Lydia DePillis, who covers the American economy for The Times, walked us through the key takeaways. The headline: inflation is easing from its height following the US and Israel's attack on Iran in the spring, but it remains far too hot for comfort and is running well above where it stood at the beginning of President Trump's second term. Does the slight easing actually relieve pressure on the Fed? Maybe, but not much. Inflation has been well over the Fed's target for more than 5 years. And although economists expect it to come down slowly for the rest of this year, several members of the rate-setting committee have expressed the view that rates are currently too low. A lot rides on the next CPI reading, which will come right before their September meeting. How much are the Iran war and tariffs showing up in the data? Last year, inflation might have fallen back to the Fed's target if it weren't for tariffs. Their impact has been waning as prices have reset at higher levels to accommodate the extra import taxes. But then the Iran war essentially replaced the fading tariff impact on inflation, not just through the price of gasoline, but also through items that heavily depend on oil, such as airline fares. What will Lydia be watching for in the next report? Grocery prices, which fell slightly in July, that's a good sign. But the resurgence in energy prices may be felt more in August, and companies are also looking to recoup margins they lost when fuel prices jumped earlier in the year. Also notable, the artificial intelligence build-out has been popping up in some strange places, like laptops and software, and pushing the index up overall. Speaking of AI, let's turn to a startup that's trying to bring some order to the chaos of model evaluation. Val's AI, founded by Ryan Krishnan, is announcing a $40 million funding round at a $400 million valuation today. Andreessen Horowitz led the round, with existing investors 8VC, Bloomberg Beta, and Pear VC participating, plus HRT Ventures and NextLadder Ventures joining. The artificial intelligence race is a high-stakes competition for capital and computing power that hinges in part on a central question: which company's AI model is the best? Val's is one of a group of startups seeking to answer that query by measuring models' performance against a set of benchmarks. Did the newest version of Anthropic's Claude edge ahead of the last iteration of OpenAI's ChatGPT? Or vice versa? Val's built an automated system to grade AI models against a set of tasks and rubrics. These tests can judge models' performance on a range of tasks, including those focused on coding, law, and finance. Val says this system makes it difficult for AI labs to game the tests. The startup also announced a new set of tests on Wednesday to measure AI models' performance on child safety and mental health metrics. Here's the business model: Val's offers its test results of major models free to companies in the market for AI. But it generates revenue by charging AI labs, including OpenAI, Anthropic, and Google, to test their models. It also sells its service to enterprise customers, such as the legal AI startup Harvey, and government organizations including the Center for AI Standards and Innovation, which pay for proprietary evaluations of their products. The startup said its revenue had increased eightfold this year, though it declined to share dollar amounts. There's a clear need for trusted third-party groups, Krishnan told us. He compared his company's service to the product testing nonprofit Consumer Reports and the credit ratings agency Moody's. Without an independent appraisal, businesses may be reliant on self-reporting from AI companies themselves. As Jennifer Lee, a general partner at Andreessen Horowitz, put it, you can't have the car makers making the crash tests. The competition is fierce, though. There are at least half a dozen other startups vying with Val's to become the dominant name in AI model evaluation. That group includes Arena, which already has $100 million in revenue and has raised $250 million from investors including Andreessen Horowitz. Now, a stunning shakeup at Forbes. When Randall Lane abruptly resigned last month after 15 years as the top editor, he said it was time to live the spirit of the brand and try something new. He didn't say what had prompted that decision, and neither did Forbes. Now we know. Lane was fired after the company learned that he had accepted a payment of about $6 million from the founder of a company that does business with the magazine, according to reporting by Ben Mullins. Lane, the magazine's chief content officer, was paid by R.J. Shook, whose company, Shook Research, has teamed up with Forbes since 2016 to publish rankings of wealth advisors. The payment was made after Shook sold a majority stake in Shook Research to PPC Enterprises, a private equity firm, last August. It isn't clear why Shook paid Lane. According to a person familiar with Lane's thinking, he considered the payment a gift in recognition of the advice he had provided Shook over the years. But Lane violated company policy by not disclosing the gift, a decision he told The Times he regretted. "I should have disclosed the gift, and failing to was a serious error in judgment," he said. "I deeply regret that, and I lost the job and team I love because of it. None of this changes how I feel about Forbes and the amazing people there." Let's run through the speed read. In Deals, a group led by Tryon Nelson Peltz's investment company, is said to be preparing a takeover bid for Wendy's, the fast food chain, according to the Financial Times. Shein, the fast fashion giant, reportedly plans to stage its IPO in Hong Kong on August 28 but may drop its valuation target below $30 billion, per Bloomberg. In technology and artificial intelligence, weeks before stepping down as the CEO of Google's DeepMind unit, Demis Hassabis is said to have pitched the creation of an independent AI safety body. And a Bloomberg piece highlights how workers are teaching AI-powered robots to take over their jobs. Best of the rest, the divorce trial of John Overdeck, a founder of the hedge fund Two Sigma, and his wife Laura Overdeck began acrimoniously yesterday, according to Bloomberg. A New York Times investigation finds that prediction firms are flagging insider traders. Many will not face charges. The agency that polices the industry doesn't have the staffing, legal tools, or will to broadly crack down on wagers that are easily manipulated. And in a battlefield drill in Germany this year, Ukrainian drones easily defeated U.S. troops, the Wall Street Journal reports. That's your DealBook briefing for August 13th. Thanks for listening. We'll see you tomorrow. If you have feedback, email us at dealbook@newyorktimes.com. And if you're not already a subscriber, you can sign up at newyorktimes.com/dealbook. Have a good day.